This is the third video in a series called The Financial Crisis Timeline, which focuses on the events of the credit crisis. In my previous video, I talked about the events of September 2008, the collapse of Freddie Mac, Fannie Mae, Lehman Brothers, and AIG, and how all of those events led to a crisis of confidence. So the concern around this time, September 2008 and October of 2008, was what is called a run on the banking system. The major concern here was that depositors, people who put their money in banks, were starting to freak out. They didn't want to lose all of their money. So they say, okay, we're going to pull all our money out and put it underneath our mattress. And as a result, the banks wouldn't have enough money to lend and meet their immediate obligations. So banks would have to shut down and start collapsing all over the country. And if this happened, lending would continue to contract and the economy would continue to slow down. This is not something that the United States wanted to happen. And so the Secretary of Treasury, Hank Paulson, decided to counteract this with a government-funded program called the Troubled Asset Relief Program, or TARP for short. The idea behind TARP was effectively to subsidize the bank's purchases of these troubled assets, these credit default swaps, and these mortgage-backed securities. And so the way that they would do this is the United States Treasury would take $700 billion in taxpayer money, and they would buy up the toxic assets, the credit default swaps, and the mortgage-backed securities and stuff from the banks directly. So the banks would get cash, and the government, the taxpayers, would get these toxic securities on their balance sheets. So that's the basic idea. Now, when this bill was originally brought to Congress, Congress was a little bit concerned, and rightfully so. They were thinking, wait a second, this doesn't make sense. These are private corporations. They're responsible for their own decisions. Why should public money be used to subsidize private failure? And that's an extremely good question, and it actually brings us to a larger issue, which is the issue of moral hazard. Moral hazard is basically giving people an incentive to take on unnecessary risk, to do things that they shouldn't be doing. And let's illustrate this with an example here. In 2006 and 2007, everything was good. These were the happy-go-lucky days of the banking and real estate world, right? There was very little regulation. Banks were reaping tons and tons of profits, but no one in the government was going to the banks and saying, hey, look, you guys need to slow down. You're taking on too much risk. That never, ever happened. But of course, in 2008, the banks said, we need help. And the taxpayers had to give a bailout. At least this is what Congress was considering at the time, right? And Congress is saying, wait a second, this doesn't make any sense, because the bankers were allowed to take a lot of money off the table. They were able to make huge profits back in 2006 and 2007, and now taxpayers have to pick up the bill in 2008? That doesn't really make much sense. The message being sent to executives at this time was, you can profit when things are good, right? 2006, 2007, everything's going up. But we'll help you out if you mess up. In 2008, you started messing up, and hey, there's taxpayer money for you. That's a very dangerous message to send to executives. First of all, it doesn't really seem fair, right? I mean, taxpayers shouldn't have to subsidize a bad decision. But more importantly, it gives a really bad incentive for risk management. Think about it this way. If I'm an executive and I see something like this happen, I'm thinking, why should I practice risk management if I'll be protected no matter what in the future? I mean, let's say that in 2012 or 2015 or 2020, we have a similar bubble-style situation where asset prices start getting inflated. And I'm an executive in one of these companies. And I say, hey, look, the government bailed out all these banks back in the day, so we'll be bailed out too, right? So I can take on all this unnecessary risk, and I'll make money for myself right now. And that's really, really, really dangerous if you think about it. Anyhow, this is the problem. This was moral hazard. And in Congress's defense, they did consider it very, very briefly in making their decisions. Anyhow, let's move on to September 29th of 2008, because this was the day when the TARP bill originally went to Congress. And what was shocking to investors is that after just 40 minutes of deliberation, the TARP bill failed 205 to 228. Now, this was the original bill on September 29th, 2008. The world was shocked, especially the investment world, and the Dow Jones Industrial Average fell 300 points in just a matter of minutes. That's an unbelievable rate of collapse. And when Congress saw this, when Hank Paulson saw this, they decided to reconsider. And 2 days later, the bill passed with some changes, but confidence in the system had been shaken. So let's see, what was Hank Paulson and Congress trying to achieve with this plan after all? There was $700 billion in taxpayer dollars on the line, right? So the original plan, let's walk through some of the upside associated with this vision. Well, the first step I mentioned, the Treasury would buy the toxic assets from the banks at predetermined prices. The banks, in return, would receive some cash. This cash would allow the banks to start lending again. When the banks start lending again, the economy starts rebounding. When the economy starts rebounding, it could take 2 years, 3 years, 5 years, who knows how long. But when that economic rebound occurs, the toxic assets would suddenly be worth a lot more. Because remember, they're tied to real estate, and the real estate is tied to the strength of the economy. So all of a sudden, these toxic assets would hopefully be some pretty good investments. And the Treasury could sell these toxic assets on the open market for hopefully a profit. Maybe taxpayers would actually end up making money on this deal. So this is the dream scenario where banks are saved, the economy starts getting going again, and taxpayers, the Treasury, end up making a profit. Win-win situation for everyone. So there was an upside associated with the original Hank Paulson TARP plan. But unfortunately, on October 14th of 2008, Hank Paulson announced a revision to the plan. Instead of buying the credit default swaps and the mortgage-backed securities, all these troubled assets, the Treasury would instead buy equity stakes directly in the banks. So they wouldn't remove the toxic assets from the books, and this was the concern. The Treasury was just going to become a regular stockholder. The banks said, hey, wait a second, we thought that the toxic assets were going to be removed from the books, but now they're going to remain on the bank's balance sheets for an extended period of time. So the banks were concerned, and they said, this we don't really know if this is going to work. But Hank Paulson and the Treasury decided to go along with it anyway, and they bought $250 billion worth of stock in several large banks like Wells Fargo, Goldman Sachs, Citigroup, and Bank of America over the next several weeks. But at least in the short run, the credit markets did not improve. The banks didn't lend this cash to the broad economy. They just took the cash and put it on their books. And a lot of people said that this was because the toxic assets were still on the bank's books, and the banks were worried. They said, we need the cash to continue to pay our liabilities. We don't want to lend it right now. So the economy continued to stagnate. That being said, let's try to understand some of the positives and negatives in TARP. Because TARP was not a complete success or a complete failure. Let's start with the positives. There were a couple of good things that came out of TARP. The biggest one was that we averted a short-term financial meltdown. I mean, if there hadn't been immediate action, we don't know what might have happened. Maybe the banks would have collapsed and we would have all been okay. Maybe the banks would have stayed alive and we would have all been okay. Maybe the banks would have collapsed and we would have had financial Armageddon. But the point is that we avoided a complete meltdown. And that is certainly a feather in the cap of Hank Paulson. It's not much in itself. I mean, it's a very, very basic level of success, but it is something to consider. The other thing that the U.S. taxpayer got out of the TARP program was stock warrants. The government wasn't doing this for free. In return for making these investments in the banks, the government actually received some stock warrants, which kind of work like stock options. They have the right to buy more shares of stock and ideally make some money on this deal. So the government was, to a small degree, looking out for taxpayer interests. But there were also a lot of negatives, as I mentioned, with the TARP plan. One of these negatives is that the banks didn't lend. That was the fundamental goal of TARP, and in that sense, it was a complete and utter failure. The other thing that was not accomplished was that we did not really reduce the risk for the taxpayer. At the end of the day, this could still cost the taxpayer tons of money if banks continue to fail. We have now invested hundreds of billions of taxpayer money in stock, so equity stakes in these banks. And now, if we have no idea what's going to happen in the future. As I give this presentation in July of 2009, we have not had that many more banks fail, but again, the future is unknown, and taxpayer dollars continue to remain on the line. So I think those are some of the major takeaways from the TARP program. But what's important to remember is that Hank Paulson's term was almost over when he started the TARP program. November of 2008 was the election of President Barack Obama, who appointed his own Secretary of Treasury, who was Tim Geithner. And Tim Geithner had another plan called the TALF. That is going to be the focus of our next video. Thank you very much for watching, and for similar videos on the financial crisis, please check out www.canjo.com.